policies were predictable for anybody who had read The Art of the Deal. This president is extremely transactional. And what that means is that for an investor or a foreign partner or anybody, the idea that you can find some policy or even ideological consistency in the proposals is wrong. The tariffs, as an example, the policy promise is the same, really are transactional. They're a way to punish enemies and reward friends. And it's very difficult to understand how that's going to play out, except for politically. If you and I were to author a free trade agreement, we could do it in a paragraph. There will be no legal or institutional constraints to the voluntary purchase or sale of goods and services for the duration of this instrument. Our last free trade agreement, NAFTA, consumed 3,600 pages. According to David Stockman, the current protocols around Trump's trade agreements now exceed 2,000 pages. The devil, of course, will be in the details, and that uncertainty won't serve anyone well. So I'm unfortunately pessimistic about the outlook for American economic performance and global wealth as a consequence of Mr. Trump's policies. I also need to say, and by the way, I was not a Biden supporter. I'm not a Trump supporter. I was not a Bush supporter. I was not a Clinton supporter. I was not an Obama supporter. I believe in the free interchange of goods and services by people who create value. End of sentence. That brings me to Doge. A lot of people, many of whom are former clients of mine, are extremely encouraged about Mr. Trump and Mr. Musk's rhetoric around the Department of Government Efficiency. David Stockman wrote a book called The Triumph of Politics, which described the derailment of the Reagan Revolution within 6 months of Reagan taking office. Reagan, you may recall, didn't win the election by an eyelash. He won by a landslide. He had a broad mandate to reduce the size of government. And politicians, Democratic and Republican, derailed the Reagan Revolution within 6 months. I'm afraid that the outlook for the Department of Government Efficiency, at least, is dire. If this administration had a lot of faith in the Department of Government Efficiency, why would they pass a continuing resolution to raise the debt ceiling? And why would the projected deficit be the fourth largest in recorded history? So I think that investors and voters who were attracted by the Trump rhetoric, or even merely disgusted by the Biden performance, need to take a look at the next 4 years in the context of the probability of a good outcome occurring as a consequence of either tariffs or the Department of Government Efficiency. And I would say from my own point of view, on both scores, things might not get worse than they have been, but they certainly won't get better. And people need to accommodate their own savings and spending and investing habits to the reality of the next 4 years and not to the rhetoric of the Trump administration. In this regard, there is a lot of good that Trump can do because most of the regulatory impediments have been done by executive order, which is to say they weren't approved congressionally, they didn't go through the legislative process, and our current political system allows executive orders to be undone by executive order. There has already been an enormous thaw in the de facto regulation of natural gas liquefaction plants, natural gas storage, natural gas transmission. There has already been, at the EPA and the Department of Energy, an enormous thawing of the backlog of unapproved projects. It isn't that the EPA or the Department of Energy disapproved of projects. It's just that when you set a project in for approval, you are met with a decade of silence. That has already changed, and changed for the better. And Mr. Trump has said that if large resource projects are brought to his attention, that he personally will intercede where an executive order can unfreeze the project. Now, it's worth noting that the resolution project has problems at the state level and the local level, too. It is on government land, so there is a government nexus that extends to state and local. And there are legal challenges around the project, brought in particular not just by the environmental community, but also by the local Apache tribe. I have some experience with local and indigenous opposition to resource projects, and often, if the government is willing to share some of the social take, which is to say some of the royalty, some of the fee, and some of the tax, with the impacted community, that the impacted community's calculus around the cost and the benefit of the project changes. Should Mr. Trump wish, he could appoint me for $1 to act as an intermediary between all partners in the resolution project, and I'm highly confident that I could get all parties on side in 6 months. The Resolution deposit is one of the largest undeveloped copper deposits in the world, and it's in a great place. It's in the Central Valley of Arizona. To the north of it, it's got a copper mine. To the south of it, it's got a copper mine. A highway goes past it, railroads go past it, power goes to it, water's there. There's communities that surround it that have great human resources, which is to say copper miners. It's 1.5 billion tons of ore running over 1.5% copper. To put that in reference, the average mine grade of copper worldwide is less than 0.5%. So it's 3 times the average grade worldwide. It's in a jurisdiction, Arizona, where they mine copper. There's a great regulatory environment. There's a great human environment. And the damn thing has been stuck in permitting for 26, now going on 27 years. No jobs, no copper, no tax revenue, a true challenge. This mine has been subjected to environmental scrutiny of a type that defies description. I'm not trying to say, by the way, that there won't be a big hole in the ground. There will be. It won't be an open pit copper mine. It would be a sublevel block caving mine, but there will be surface subsidence. There will be some disruption of groundwater. All of this can be mitigated. I mean, understand that this is a mine that will generate a couple $1 million in surplus cash flow per day. There's a lot of money to go around. In the period 1982 to 2022, arguably, non-prudent investors didn't need gold. When people said to me, including on your show a couple of years ago, when's gold going to move? I said, well, I think it's going to move in 2000. In other words, 20 years ago. The price of gold then was $250 an ounce. Now it's, what, $3,400 an ounce? So it's moved 12-fold already. Then people say, well, is it over? Have I missed it? And to them, I would answer that gold really moves when people are concerned about the maintenance of their purchasing power in fiat-denominated instruments. And I think that fear is very much alive. That's the most important thing. The interplay between the cost of living increase and interest rates. If you are somebody who believes that the CPI is a good indicator of the deterioration of the purchasing power of your savings, you don't need to buy gold. But the people who construct the CPI don't shop where I shop, and they don't shop for the things that I shop for. And the CPI doesn't include tax. When I look at the basket of goods and services that I buy, suggests to me that in the period 2020 to 2025, the deterioration of the purchasing power of my savings was between 7.5% and 8%. Look at gasoline, look at energy, look at health insurance, look at health care, look at groceries. The idea that my purchasing power has declined by 2.5% compounded for 5 years is stupid. If you believe, like I believe, that your purchasing power is declining at 7.5% or 8% a year, and you juxtapose that with the interest that you receive on a U.S. 10-year Treasury, the world's benchmark savings instrument, that suggests that you lose 3% of your purchasing power every year for 10 years. There's no more valid reason I can think of to be concerned about the maintenance of my purchasing power than an absolute guarantee that in conventional savings instruments, I'm going to lose 3% a year compounded for 10 years. It means I'm going to be 35% poorer 10 years from now. And am I concerned about that? Hell yes. I can do arithmetic. People asked me about 3 weeks ago on my own podcast. They said, Rick, you're a broken record. You're a one-way street. What would cause you to sell your gold? I said, that's easy. A balanced federal budget, a fiscal plan that accommodates $100 trillion in net present value of unfunded entitlement liabilities in the United States is $100 trillion. So a balanced budget, a fiscal plan that deals with unfunded entitlement liabilities, and positive real interest rates, which is to say an interest yield on the U.S. 10-year Treasury that was greater than the deterioration of the purchasing power of the U.S. dollar. By the way, shadow stats, John Williams says that inflation is running at 12%. That number is not a number I need to prove my point. My point being that until those 3 criteria are met, that the reasons to own gold is in place. What I see in front of us, particularly with the unwinding of $100 trillion in entitlement liabilities, is a return to the 70s. I see us honoring the nominal value of our entitlement liabilities by inflating away the net present value. The Office of Management and Budget calculated that in the decade of the 1970s, the U.S. dollar for U.S. dollar consumers lost 75% of its purchasing power. This isn't my number. This is the government's number. In that same period, the gold price ran 30-fold. Now, admittedly, a third of that was gold catching up with price controls. My own belief is that in the next 10 years, the purchasing power of the U.S. dollar will again decline by 75%. And my operating assumption is that gold will keep pace with the deterioration of the purchasing power of the US dollar. That would be a fourfold increase over 10 years. Could it be threefold? Sure, I don't know. What I do know is that holding a relatively small proportion of my portfolio in gold and gold stocks, I hedge against a lot of sin elsewhere in my portfolio, particularly in my bond portfolio. A circumstance where the purchasing power of the dollar declines by 75% absolutely massacres a long bond portfolio. It doesn't hurt it, it obliterates it. We had a period 1982 to 2022 where real and nominal interest rates were coming down. That's over. This is just arithmetic. This is not narrative. If somebody has a 5-year time frame, the oil and gas market is insanely cheap. Could it get cheaper? Absolutely. We're coming into an economic slowdown. Oil and gas is economically sensitive. Fewer buyers is hard on price. So in the near term, I think oil goes lower. Having said that, I've been a fairly consistent buyer of Exxon the last 2 weeks. I'd like to buy a lot more, and I'm happy to see it go lower because my conviction is so high. Speculators can look at the Canadian oil and gas market because something terrible there just happened. They elected Mark Carney as prime minister. He has the same attitude towards energy as his predecessor, Mr. Trudeau. The difference is that Mr. Carney is capable. I would much rather an incapable foe like Trudeau than a capable foe like Carney. So there's real political risk associated with the Canadian oil and gas space. It's so cheap that I own it anyway. But other investors might want to think about that. But the oil and gas sector itself is insanely cheap on a 5-year basis. It doesn't mean that a year from now won't be cheaper than it is today. But the truth is that I don't live my life in 1-year increments. I live my life in 5 or 10-year increments. And while I might be unhappy with my Exxon ex-dividend in a year, I'm going to be ecstatic in 5 years. Most of your listeners aren't going to do the work that is required to go too far down the quality trail. There is more money to be made in a $500 million producer than there is in Exxon. But there is surer money to be made in Exxon without having to do any work. I spend about an hour a month on each of my small cap stocks. I can do that because I don't have a life. I enjoy it. But for most of your listeners, they would be better off buying the highest quality companies in the sector and then going fishing or playing with their grandchildren. What's happened in the very near term is that the pace of Japanese restarts, while it's been politically favorable, the reality has been that the uptake in fuel consumption by the Japanese has been slower than many people, myself included, thought. And what that has meant is that Japanese inventories haven't been sold, but they've been leased, which is to say the Japanese have allowed other people to use the inventory in return for not money, but rather the pledge of the same quantity and quality of fuel coming back 3 or 4 years from now. So the increase in the spot price in uranium has been constrained by about 15 million pounds in surplus Japanese supply. Remember, the prices are set on the balance between supply and demand, not the whole market. The structure of the uranium market is insanely bullish. The benefit of that structure will be felt by 10 or 12 companies rather than the whole 100 companies that exist in the space. So it's all about understanding the impact of construction finance, the term market, and individual issuers. It's important that one do the work in the uranium space. If one does the work in the uranium space, the next 5 years are going to be really pleasant.